Hi guys, thank you so much for all our viewers for tuning into a fresh, brand new edition of Money Control Markets Weekly. I'm Karunya Rao. Joining me today is Mr. Deepak Shenoy, the founder of Capitalmind. Deepak, thank you so much for joining us to talk about the markets. Of course, this week has been relatively lackluster. The markets seem to have been taking a breather of sorts. Of course, this was kind of expected by many people on the street, given the phenomenal up move that we've seen on the benchmark indices last week. 17,500 now seems like an important level to watch out for as far as Nifty 50 is concerned. What do you think is the way forward? Will the markets keep consolidating for some more time before it meaningfully picks up pace again?
On the show, the markets actually have been quite kind in the last few months. Though, if you look at the markets, there are two specific phases. The large caps, which largely the Nifty kind of represents, has only picked up in the last month or so. And in the last few days, it's kind of petered out. But before that, there was a lot of action in the mid and small caps. And while they corrected in August, they have also formed a significant rebound in the last 1 week or so. So we're seeing, action contradictory here in sense there's more distribution among the larger caps, but accumulation in the mid and small caps. So it seems to be that it's driving force could be retail investors and it could be foreign investors, both of whom continue to be putting money into markets in India at least.
All right. So, what should we make of the kind of pullback that we've seen this week? Is there anything that's bothering the market? Because even last week, when we spoke about market trends and market moves, one factor is that this rally is not as appreciated or as exciting or enthusing for people so far. It's been a bit of a bittersweet kind of a rally because it's not been broad based really. So, given the pullback now that is happening in certain pockets, what should how should one look at it?
So I think here the problem largely stems from the fact that the banks haven't really participated meaningfully in the rally. Not all banks have. If you also look at it, the largest movers in the last few days have actually been the companies like Reliance versus the banks, which usually lead the rally. The IT pack has kind of pulled back a little bit, and then you've seen a lot of or some movement in some of the FMCG companies, it's kind of still been flat. So the movement has largely been in Reliance in the telecom companies. And perhaps that is what's also making this rally a little heated, saying, what's happening here? Why are the laggards starting to perform? And perhaps also joining this is the fact that the world markets haven't really done very well. Today also, I think the futures of most non-Indian markets are down. So there's a bit of a correction happening worldwide. We've even seen a Bitcoin and a lot of those other alternative assets correct quite significantly. So maybe this is just a consolidation phase. But the market's been so stretched, so I think it needs breathers every now and then. I believe people have hated this rally from January. So this is like just a little comeback, little pullback, not even 1% or 2% right now. So it's just too small to call it a correction also, to be honest.
But do you foresee a larger concern or a bigger correction of sorts coming by at these levels?
So I think markets should correct. In general, markets are not supposed to go only in one direction. So they're supposed to give you these little, 5%, 10% pullbacks and then back to rallies and so on. We just haven't seen that meaningfully this year. We've not even seen a 10% down move on the Nifty, though a lot of stocks have fallen quite substantially. So, it's the indexes that haven't really fallen quite deeply. Even the small cap index has not even fallen 20%, I think, from the top. So,
Hmm.
given that, I think a correction is well due. We should have one. But I wouldn't be surprised to see the market go up another 10 or 15%. before it corrects. You're reaching territory where people are not going to be able to explain valuations from any meaningful standpoint. So 80 times earnings becomes, oh, okay, it's 80 times, it's fine, we can pay 80 times earnings. It's become part of common folklore, and that
Hmm.
kind of thing is scary because you can't predict the end, but you know that at some point it is going to correct meaningfully. That could still take 5 6 months away or even a year.
One thing that we noticed this week was while the overall heavyweights and large caps were a bit lackluster, a bit muted, there was good amount of action seen in a lot of mid and small cap names. Many of them even today made fresh 52 weeks high, while everything else was quite subdued and quite mellow. What do you make of the action that is taking place in the broader end of the markets? I mean, are there any safe pockets there that investors, especially retail end of the investors, can look at?
Yes, I mean, if you look at the small cap and the mid cap indexes, they have both made current all-time highs, I think, as of literally today as well. So you're seeing a lot of mid caps and small cap names starting to move. We are seeing a lot of the technology companies move quite significantly. I think we own an investment in InfoEdge, which is Naukri.com, and a bunch of investments they own. There is India Mart. Again, we own this. BSC. Again, we own this. But they've all made new kind of highs. Though India Mart and Naukri kind of moved back in today, we did see a big move on BSC. We did see a bunch of moves coming around in stocks in the textile sector as well. So KPR Mills, again a mid cap, small to mid cap in the textile space. A bunch of other stocks there. I think a lot of these stocks are moving. We're seeing some movement in the real estate space. This may be early, indications that at least a speculation that real estate transaction numbers, not prices, but transaction numbers are starting to improve. I see this as a sign. There are two things that's happening here. The economy is slowly starting to come back. So some fundamentals may start improving in the next 2 quarters, but I do see that the market is, very, very gung ho in terms of liquidity. So people are putting money into anything that they believe will recover fast. So, given that the small cap and mid cap universe is where most of the action is, the large cap universe is relatively muted, at least in the last few days.
Okay, that's correct. But let's also talk about a relative outperformer, which has been the FMCG pack, at least as of this week. Especially, extremely slow movers like ITC also finally saw some positive action. How should one read into the consumption space right now and the way things are? Do you see meaningful pickup, meaningful triggers here for times to come?
Honestly speaking, I think, Karunya, these spaces, these companies in these spaces are very, very richly valued. So if you're investing in the markets, you have to invest for two kinds of things. Either you're investing in longer term value, where you see that you're paying substantially lower than what people might pay in the future for a company, or you're paying heavily for growth. FMCG, they call it quality and all that stuff because of high return on capital employed, but there's no growth there and there's not much value there because you're paying 80 times, 90 times earnings. For most of these companies who can't even compound the growth on their capital that they generate from the profit. So, in a
Hmm.
way, I think the most of the space is extremely richly valued, and we will see corrections here at some point. But it's a good. Some of these companies are good brands to own. They will not grow at more than 12 or 13%. Maybe 1 or 2 quarters they might show something, but I think in the FMCG space, and ITC is never going to be richly valued in comparison with most of the others. We think this is a space where we are not getting in because of lack of valuation modes and lack of growth.
Right. I have a multi-pronged question now. I want you to address a couple of themes for me because If we look at IT, there was massive positive action that was taking place over the last few weeks. That seems to have taken a breather this week for a change. Earlier, the banks were lagging behind, while we have seen a bit of a pickup in certain pockets within banking and financials. And one thing that has been a constant for the last few weeks or months rather is the sluggishness in auto sector. Talk to us about, what's happening in all of these three. Of course, IT is something that we would like to hear more from you, followed by financials, which pockets you like best, and then auto.
So, from an IT perspective, of course, stocks have been quite strong. We're very heavily invested in the IT sector, so little biased here. But we're seeing two things happen: one positive, one negative. The positive part is that the deal sizes and the deal counts are improving quite substantially for both mid cap and large cap companies. We're seeing a lot of uptake on project, finalizations and also sizes. So what was a $500 million contract would now become a $1 to $1.5 billion contract. I mean, I'm just talking at the highest end, but even the smaller levels, you're seeing larger numbers. But the problem is then the fulfillment is an issue because hiring has become extremely difficult. Attrition is very large in the tech space. And therefore, I feel there's going to be margin pressure, even though contract sizes have improved. A lot of the assumptions are based on earlier calculations of kind of cost, and that cost is going to go up quite substantially. I'm talking 30-35% cost increases, and 20-25 to 30% attrition numbers will be common. So that's a negative. But in the near term, you might see some of these challenges hurt these companies. But in the longer term, I think the brand and the scale that they can build from here, quite positive on that. That's why we're invested. There's also financials wise, there's going to be a very big dichotomy. You see the small finance banks, they've been crashing quite substantially, while the larger
Hmm.
banks have been holding up. You see companies like Idea, where the exposure by certain banks, those banks have kind of been weaker because Idea has a large exposure for some of them, and therefore there will be an impact when if Idea is not able to pay its bills, if that happens. But I think here that you should avoid financials until at least the results for this quarter come by. Last quarter was when you had, that was the April, May, June quarter was when you had the massive issues that we had with COVID, the wave two, and those accounts, if they had to turn NPA, will only be visible in this quarter results. That is the current quarter, which is July, August, September. So
Hmm.
waiting for those results makes more sense. I think here is when we find out who's strong and who isn't, who has enough provisions and who don't. And therefore, while it appears like some of the larger banks and especially private banks seem to have the edge here, we may actually be surprised that the public sector banks start to turn a leaf in comparison. If retail is impacted more than corporate, corporate is relatively unaffected in comparison with retail in the COVID crisis. So that's on the financials, and of course, I think what was the third one? I'm sorry, I forgot
Auto
which one.
sector.
Auto, yes. Auto is actually currently affected by two impacts. The shipping costs, especially when you're doing imports of parts, that part, I think shipping costs have gone up, especially if you're not manufacturing some of these things. And not every car manufacturer manufactures everything in India. Um, but also the chipsets, the chips that go into the CPUs of which are the control units of cars. So those chips have actually seen a major impact in terms of not enough production. So things are demand is may not be high, but supply is even lesser. So we're seeing prices go up. We're seeing delays in time. So we expect this quarter to be very low for at least four wheelers. We're seeing better turnaround for trucks, some trucks, and two wheelers seem to be slowly coming back into action. So I'll probably take bets in that order. However, we are invested in auto, and we've been invested for a long time. So I'm hoping at least for a pickup from the December quarter onwards. If not by this month, the numbers don't look good at all for this month. It won't look good for October or November either. So, but let's just hope that the shipping crisis and this chip crisis kind of eases up, and that's when we'll see the real situation on demand and supply.
Right. Since we're talking about various sectors, I have some viewer comments as well kicking in on YouTube and Facebook. One of our viewers wants to know about pharma sector since we've not touched upon it yet. Do you have a view there? Because the viewer is saying many Indian players who export a lot are not seeing any positive action in tandem with the kind of exports exposure that they have. So do you have a view there?
Yeah, I mean, to be fair, the last year has been almost the year of pharma. I think it's one of the best performing indexes, right? So they got a lot of love in the last 11 months, and maybe 1 month they haven't got any love. So, I think the markets are just being, okay, we had a favorite, and now we have some others who are also upcoming. But honestly speaking, the growth is ahead in of the pharma sector as a whole. But also, you have to look at specific areas. Pharma is a very wide space to play, and a lot of the exporters are betting on this China plus one phenomenon. I think that will be one of the driving forces for at least India also to de-risk from China. We import a lot from China, so substituting part of that with local domestic producers, who some of whom are already also listed, will increase revenues quite substantially for these companies. So I think the next 3 or 4 years should still be good for pharma, but you'll have to be a little more selective. Some of these stocks have run away too far, and I don't think. I mean, we're looking at even promoters selling reasonable amounts of stake in their companies because the stocks have run up quite a bit. So, I think it needs to be a little more selective play. But if you don't really care, just buy the pharma index of sorts. I think that should still do well in the next 5 years. But that's not an advice, of course. Everybody takes it individually. We have investments in the pharma space, so a little biased, of course, there. But looking forward to great action in the next 5 years.
Okay. There are some more viewer questions trickling in, but before we address that, Deepak, I just want to understand many of our viewers are typically retail investors. They do keep writing to us about, how they should plan their strategy in the market, given the way the markets have shaped up. If you look at the last 2, 3 days, there was a bit of a, wild move that was coming by as far as mid and small caps were concerned, which affected a lot of these retail guys, some of whom are now apprehensive towards investing in these companies. Overall, if one has to devise an investing strategy, what advice would you give to somebody who wants to pick stocks from mid and small cap space at the current juncture?
So, two things about mid and small caps. Firstly, they're notoriously difficult to track because you don't have enough data information. They're not as well tracked by the analyst community. And a lot of the small caps may be excellent companies, but they may not get discovered by larger institutional investors. So, you have to be careful that you don't invest in something that is like a value trap in a way. Great company, never discovered, and it runs through its entire cycle of greatness, and then nobody ever discovers it, and then it kind of languishes in the market. The second problem, and people tend to think of this as, oh, this is a great company, I should put 10, 15, 20% of my investments into this. But because of the lack of knowledge and lack of depth of availability of knowledge of about these companies, it's actually better to diversify. So spread your investment across a larger subset of companies. Now, small caps and mid caps can easily do 2x, 3x in a very short time. To give you an example, I think a lot of the mid cap companies in today's space have already doubled in the last 3 months. So you can get a significantly higher rate of return on many of the small caps, which also means to adequately cushion yourself from some of these companies falling 30, 40% also. They'll easily fall 40, 50%, and they have, many have, so while some companies have doubled, some companies have fallen to half in the last few months. So to keep yourself, insulated from that risk, don't concentrate your investments, especially in mid and small caps. I would say spread it around. Unless, of course, you're a fund manager, in which case you don't need my advice, and you probably have enough knowledge to analyze all these companies by yourself. So I think largely the retail public that's getting in should aim to diversify. Don't be afraid of owning a large number of companies, because it's only time that will show you who is consistently performing. Hold those and get rid of the ones that aren't. That's the only way to play a market like this.
Keeping it with some more investment, tips and suggestions that you have for our viewers, we often also receive queries on investing in rates and InvITs from our retail investors. Would you like to highlight the importance of investing in all of these other asset classes as well, which typically a newbie who's just entering the markets may not be aware of in terms of what to expect, how to go about navigating the space?
So to be fair, these are not easy investments to kind of analyze, because you need some knowledge of the space. InvITs are infrastructure investment trusts, investment vehicles. You invest in, effectively what you invest in is cash flows. So you have to understand. So for instance, if I were to say, listen, I'm getting a salary of uh, say 10,000 rupees a month. Um, how much would you pay me for as a one-time payment to be able to get all my salary for the next 5 years? So you're going to look at this calculation, say 10,000 a year, maybe some increase every year for the 5 years. We're talking of X, and then all my, so instead of thinking of 10,000 into 12 into 5, which is about 6 lakh rupees, you might say, listen, I'll discount that to the current rate and I'll pay you a sum of 3 lakh rupees. And on that 3 lakh, I'll get 10,000 rupees a month. So just as an example, this is an example of an InvIT. It's just an infrastructure project. It could be a tolled road, highway, set of highways bunched together into an InvIT, or it could be a set of electricity transmission projects where a power generator and a power consumer effectively will be paying the transmission line a certain amount of money every month. These are complex things to understand, but the idea is to understand. If you understand the concept of dividend yields, or yields of any cash flow, these are investments where there will be a cash flow out every quarter or every year. And therefore, these are not investments that will, like, double in 5 years because this company is doing really well. No, the company actually has a very fixed set of cash flows. It may grow for different other reasons, but largely these are yield generating assets, and therefore the investor who should look for them is someone looking for an asset price that is relatively stable. But that means the core price of your asset will be roughly the same, or maybe not much more than what it is right now, but you will get cash flow out of it every month. So if you're that kind of an investor who needs that cash flow, understands the risks, then REITs and InvITs are for you. REITs are simply real estate, commercial real estate projects, like commercial office complexes, where they take the rents and say, we'll spend a little bit here and there and give the rest to you as a cash flow, pay us a fixed sum in advance. So the investor here is a person who's interested in cash flow, not in really growth.
Okay. Okay. All right. Let's also talk about some hot stocks of the week gone by. Of course, we've seen massive moves come by counters, heavyweight counters like Reliance Industries. There was Bharti Airtel today, once again today. What a phenomenal run up coming there. So there's a lot of action that's taking place, especially telecom, digital services. Of course, there is expectation of a duopoly as well that makes a lot of people bullish on a stock like Airtel as well. What would you advise investors when it comes to these two heavyweights? In terms of how they should go about planning their investing strategy?
So, Karunya, we own both of these companies, very biased. And of course, not what we're saying is not advice, because advice is personal. But here's our thought process around this. India
Okay.
is going to grow quite substantially from a telecom usage perspective. This is not just today, it's happened in the last 5 or 6 years, but it's only going to increase. There are going to be not just humans using telecom equipment, but also devices. Today, it's your phone, tomorrow, it will be your watch, it will be your fridge. I mean, I don't know what else will come in, but they're already seeing, your lights are connected to the internet, and so many of these things start coming in. There's going to be demand for data and bandwidth that continues over the next few years. On top of that data and bandwidth, people will build applications. They have already built we are streaming this live on the internet. No longer do people have to buy a TV subscription in order for people to be able to see content. This is the phenomenon that will just increase in the next few years. The market itself of players, from three will probably come down to two, and it's coming down quite dramatically because the third player, Idea, seems to be in financial trouble without any easy solution here for being able to bail them out. So, and both the promoters, Vodafone and the Birla Group, have not said that they will be putting in more money to rescue the firm. So the feeling is Bharti and Reliance will, which are the two bigger players, will probably take over that market and benefit, of course, from the expanding universe of data requirements and applications that use those data to provide more services to customers. So I think if you're in this business for the long run, if you're thinking 5 to 10 years, then these businesses right now, which are not producing great returns on capital, in fact, terrible returns on capital, if you ask me, but I think revenues going up because they're so fixed asset heavy, just a slight change of numbers can make a massive difference between a 30% margin or a 20% loss. So, given that we're seeing prices increase, volumes increase for both Bharti and Reliance, and that's one of the reasons why we have invested in them. And I feel if this is a theory that anyone else subscribes to, then they can consider these stocks in their portfolio.
Few months ago, when the market was opening up after the second wave of COVID, everybody was talking about investing in reopening themes, right? Hotels, restaurants, QSRs, aviation. All of these were, the talk of the town. And then the last few weeks, we've also seen smaller sectors like paper and textiles witness strong traction. What will be the flavor for the next few weeks, according to you, according to your assessment of the markets? Where should one, or which pockets should one watch out for?
So honestly, Karunya, if you ask me about the next few weeks, it could be anything because the market has very let us just say short-term stories of fondness. So they take over a few players, they take over one sector, and that sector becomes the most popular one for 2 weeks, and sometimes you don't even know why. It was at one point it was companies which had the name Adani for a while, and then it moved to the reopening concept, malls or theaters and so on. Somewhere else it moved to now the IT companies come back. So we can't easily predict what will happen in the next few weeks, but we're seeing initial action in real estate. A lot of real estate players were making new highs as of 2 days ago. They've corrected a little since. But also so we're seeing textile companies starting to move today. They've seen exchanges, from stock market exchanges to energy exchanges kind of move up quite substantially in the last few days. So I think one of these sectors will probably take over. It may not be the old bets of pharma or banking or maybe even some of the financials, but I think some of these other sectors will come in and take credit. We are in a reopening zone anyways across the country. Everything is slowly limping back to normal. So you might see some positive news coming from any sector, and you could see negative news also as well. I just hope there's not so much negative.
Okay. From mainstream markets, let's also talk about primary markets that were a buzz and how in the last few months. Of course, right now we're witnessing a bit of a subdued action there as well. But overall, given the slew of IPOs that the market has seen and the big ones that are yet to come, the likes of Paytm, Policy Bazaar, and many others, what is your sense about this whole rush of IPOs that has been happening, and how should retail investor approach this? Should is the FOMO justified, or is it not too late perhaps to wait it out, see how the stock plays out, and then eventually invest after doing their proper homework and reading enough reports?
There's absolutely no problem in doing what you just said, Karuna. In fact, it's probably a suggested approach because you don't know much about how companies will behave after they turn IPO. But very importantly, if you think that a company has a very wide, big market, and that it's relatively underpenetrated, that space itself is relatively underpenetrated, then we have a potential winner in a. I mean, you just have to invest in the fact that the sector will grow, and any player in that sector is going to participate in that growth. Now, that could be, for instance, a theme of more market exchange related transactions. So therefore, there is transactions moving to exchanges rather than to one-on-one kind of transactions. That is one layer. There could be a move to digital usage of certain networks. So you have players that own music, for instance, and the music monetization earlier used to be parties and large gatherings, or stuff like that. So it used to happen through radio or through TV, but now it's happening through YouTube and a lot of these online channels as well, where the revenue sources seem to be substantially larger and there's a lot less of the middlemen involved. So one of those themes can also change going forward. I think a lot of this, if you think of it as a theme, uh, a lot of this is dependent on how you think the new companies that are listing will be able to take over this space. Now, we own investments in many of them. In Zomato, for instance, we have an investment, but we think here that it's the space that will grow. It's not just that the company, I don't know whether the company will actually be able to handle the pressure of public scrutiny, because we don't know. They're only just listed. So we're also building up a position over a period of 1 or 2 years. So start with a small position, wait till we see how they perform, and then add more as we go around. And this would have worked very well for you for some IPOs, and where it doesn't work, you're out with a smaller allocation. So you don't have to, lose lesser when you lose, and you win more when you win. So that's the way to play the IPO market. But I don't think people should invest for this listing pop that everybody seems to. What's the point? You'll invest in IPO, some 7,000 other people will invest in it, and then everybody gets one lot, which is like 15,000 rupees. And if
Yeah.
that goes up 30%, you get very excited and go on Twitter and say, "Oh, I made 30%." But that 30% will buy you, like, I don't know, you know, if
Worth a Zomato order, perhaps.
yes, sometimes in fact they sell it for a few Zomato orders, and then feel very happy. The 30% is useless if it's not on substantial capital. So I think this playing for the listing pop is a useless exercise.
Well, before we let you go, one final word of advice from you to all the retail investors who are watching us right now, those who are entering the markets or who are planning to expand their portfolio and scale up their investment in terms of quantum as well. How should they sort of plan a proper strategy or a proper list of things or assets that they should be definitely looking at to must have in your portfolio in terms of, I mean, across assets?
Yeah, in fact, I think a few points that I want to, and the first and most important point that I want to say is markets will go down. So somebody who tells you that oh, plus 20% is the minimum you'll get in the markets, don't believe any of that. Your minimum, you can see minus 60%. We saw minus 40% just last year. Of course, we got lucky and the market came back, but easily minus 20-25% you should expect from a market that will be like this. So the idea is to start investing and keep the investing going on even through these downturns that will come. And that's how you build large capital, not by saying I'll put all my money on the market today and oh, it has to double from here. It's not going to happen. You're going to see some really big negative cycles. So don't get excited or overexcited because your neighbor made some money and therefore you should. The second part about a market like this is that you don't have to invest only in one asset class, like you said. You can be in equities, in large caps, mid caps, small caps, but you could also be in REITs, betting on the real estate cash flow. You could be betting on fixed income markets through fixed income mutual funds. You can bet through American and non-Indian, even Chinese equities, through mutual funds which invest in those spaces. You could invest in gold and a few other commodities as well. I think you should have a balance. That I don't like gold, so I'm not going to tell anybody to invest in gold. But apart from that, I think one deserves to keep money in all of these buckets. You may not see that fixed income is like 5% a year, and you're looking at me and saying, Deepak, the market is giving 5% a week. Why would I bother with something that gives 5% a year? But when it gives you minus 20%, that is when you're going to say 5% a year is also good enough. So you should have legs in all of these baskets, if you may, and that is what's going to give you some protection on the downside. Of course, the last piece that I would like to tell everybody is, uh, we no longer believe whatever we hear as a WhatsApp forward, right? So because you know that a lot of it is made up, and the stock markets are like that. People make stories up all the time, and therefore, just because some stories seem to have come true, the narrative is nice to sound, and it sounds very nice. Oh, China has this, and therefore India is going to become that. These are all nice to hear, but often it's not connected with reality, and we're a really small part of international markets. I was telling someone yesterday, our entire market trades in one day as much as probably one stock in the US trades in 2 hours. It's we're really small part of the international market. If things change worldwide, if the world sneezes, we'll catch a cold. So we should be cognizant of the fact that not everything is as hunky dory as it seems, and things can change really fast. Don't you know believe everything you hear. And even from me, I have a story to tell, and it doesn't mean that that story is going to be right. But the only thing that I can say is I'm happy to be proved wrong, and I'll change my direction if I am. You should be ready to do so when your stories also become wrong. So just leaving that three small pieces of advice.
Wonderful wisdom coming in from Deepak Shenoy. Thank you so much for joining in and helping us make sense of what's happening in the market and what are some exciting opportunities to look forward to. Thank you so much once again for joining in, and thank you to all our viewers for tuning in.
Thanks, Karunya. It was lovely to be here. Thank you.
Likewise. Thank you.